investor. You need to match your idea, your company, to the right investor. And that means a match in terms of thesis, stage, and market focus. Let's talk a little bit about each one of those. Many VCs are thesis focused. They have a broad idea for how they're going to invest the funds that are in their fund. For example, they have a strong belief that software as a service is the leading business model that's going to take over the world, and they will only invest in software as a service companies. So if you don't have a software as a service business model to your product, there's no point in approaching them. Conversely, some are very focused on their thesis is very focused not on business model, but on market segments. There are VCs who focus exclusively on, let's take an extreme example. If a VC firm is focused on renewable energy, there's no point going into them with your enterprise software for IT organization idea. It's no match on the thesis, and you won't get looked at. The second thing that you want to look at is the stage. This has become a fairly blurry criteria in recent years, and there are quite a few funds, certainly the well-known ones, that will invest across all stages, from very early seed stage all the way to pre-IPO mezzanine rounds. But in many cases, and I think especially for entrepreneurs who are tuning into this webinar series, you will want to find a VC who's fully focused on the earliest stages. Seed investor, maybe a pre-seed investor, maybe an A-round investor, but not beyond that. Because those who are focused on the later stages will be unlikely to be taking the risk associated with an early stage company, and in many cases won't have the ability to give you value add beyond money that will help you grow, because they don't know how to work with companies in that stage. After you've created a short list of potential investors who meet these thesis, stage, and market focus criteria, it's a good idea to try and talk to some of the entrepreneurs that they've funded in the past. Chemistry with your investor is important. Remember, you're going to be giving a very large portion of your company to these people. In many cases, you will be giving control to them. You will be placing your own future in their hands, and they will have the ability at certain points to let you go and replace you with a different CEO. And there's nothing harder for a founding CEO than to be replaced by the VCs because of distrust. So talk to the, if you can, the founders who got funded by them. Find out what they can say about the personalities of the people involved, about the particular partner who will be investing in your deal, and be judicious about this. I know this sounds a little bit standoffish. It's very easy to come and tell you, be choosy, be picky about who you work with when you're struggling to just find anybody who will give you money, but do your best not to overlook this piece of advice. It could come back to haunt you. And then finally, a tricky part is, once you've identified a VC who fits your idea in terms of focus, thesis, stage, that's great, but it also in many cases means that they've already made investments in a company that is similar enough to yours to be too close for comfort. It's unlikely that they've invested directly in a competitor of yours, and I think that it goes without saying that you won't go and pitch to somebody who's invested in a direct competitor, because they won't do it, and you wouldn't want them even if they did, because there's always the potential for leakage between the companies. But even those who are focused on your segment but haven't funded a direct competitor might have companies that are a little, in their view at least, are a little bit too close to comfort. So that can turn out to be a little tricky. So that covers, I think, most of the material we wanted to discuss today. Give you a brief sneak preview into what's coming up in 2 weeks' time in part 2. We gave a high-level overview today of how to build your pitch in 4 acts: the villain, the hero, your execution strategy, and your vision. We'll go into a little more depth into each one of those elements in part 2. We'll cover some tips and tricks, do's and don'ts in terms of what to do during your fundraising. Very important, how to read investor feedback, which is not always direct, and you need to read between the lines to figure out if you're wasting your time with a particular investor, or if it's worthwhile to continue to keep him in the loop, even if he didn't make an immediate response to you. We'll talk a lot about valuations, how do VCs value companies, and what you should be doing in preparation, what ideas you should have about your own valuation. Talk about different ways to get that early money in, whether it's through an equity investment, from a formal round, through something like SAFE, through a convertible note, and so on. And we'll go over the fundamentals of the term sheet.